Good morning and welcome to Daybreak Europe. I'm Kriti Gupta in London. Let's get to the stories that set your agenda. The Magnificent Seven driving a rebound in U.S. stocks. Apple unveiling plans for a new in-house AI-powered chip. Meanwhile, monetary policy traders repriced the ECB, putting it on track to cut before the Federal Reserve. Christine Lagarde insisting that the ECB does not take cues from across the Atlantic. Plus, in the corporate space, Wall Street bank earnings are in focus. JP Morgan, Citi, Wells Fargo, all set to report today. It is Friday. We're ready for the weekend, but there is still plenty to digest in the next 24 hours. Let's get a quick check on those markets. When you're looking at the futures picture, you are seeing it broadly positive on this side of the Atlantic. Eurostoxx 50 futures higher by about 0.6%. Even the FTSE 100 seeing some green on the screen higher this morning, higher by about 0.4%. Is that, however, pricing in that full story of the ECB actually cutting? Is that a positive rate story? At the end of the day, though, the S&P futures story, the U.S. not seeing as much green on the screen, despite that massive rebound that you saw in the U.S. Tech space in particular. You usually would see the Asian or European traders would hop on that trade. They are not this morning when you look at the futures picture. That's your equity story. Let's talk about cross-asset, though, because the bond market matters more and more now. Now that we have these interest rate differentials really coming to the forefront of the trade, you are looking at 457 on the 10-year yield, down about a basis point this morning, but still the fact that we are sustainably above that 450 level, to me, I think that's crucial. Is 5% on the horizon? We're going to dive into that throughout the rest of the show. FX, though, gets interesting. You see this volatility in the bond market. You're not necessarily seeing it in FX. 107.13 on euro dollar, 125 on cable. You're starting to see the European currencies crack, but still really a dollar story driving it. And I would argue it's a dollar story driving the commodity space as well. Brent crude trading at a 90 handle and kind of stuck there, only higher by 0.6%. That is your cross-asset story. I want to get a quick check on how those Asian markets are faring. Tanya Chen joins us from Hong Kong. She is all over that story. Tanya, walk us through it.
Hey, good morning and happy Friday. Yeah, so Asian stocks are trading a bit mixed today. I'm going to take you into Japan first. Japan equities are a bit on the firmer side, really helped by this real estate sector. It's surging. We've seen some companies out there announcing buybacks. We've also seen some companies talking about cutting strategic holdings. So that's really boosting investor sentiment there. Also, the construction names in Japan are also giving this a lift. The government's been obviously handing out a lot of support to projects around chip makers and semiconductor factories. Another kind of company to flag in Japan, fast retailing, the operator behind Uniqlo, they did report an operating miss due to weakening sales in China. And so we might see a slump continuing there as they're trying to shift their key market to you over there in Europe. And also a quick mention on the yen there. I think we're steady now around 153. It had continued to weaken over the past week. And the traders there are really on this yen intervention watch. Just something really interesting to note, because JGB is also posting their worst session this week. And last year, we had seen officials really coming in and doing a lot of intervention, especially when we saw the yield nearing that 1%. And we're really not getting much of a squeak in Japan this time around. Just flipping to the next board, I'm going to take you into China equities. We're still on watch for some data out of China, trade data, loan growth data. All of this could be due sometime today. And next week, we'll have GDP numbers as well. The Hang Seng Index is kind of getting close to the 17,000 threshold, which would really send a negative signal to local equities here. I'm also going to mention just some currencies on the board. The Korean won was weaker earlier today as well. The Bank of Korea deciding to keep policy settings steady. They're really going to keep an eye on inflation, but the won there is, as you saying, weakening kind of on that strong dollar. Singaporean dollar also kind of steady now. Earlier, they had a central bank decision as well.
Tanya Chen in Hong Kong walking us through the major story we need to know coming out of Asia. We thank you so much for bringing us that report this morning. We go from Asia to right back here in Europe, where the ECB has basically confirmed that's going to be cutting rate at its next meeting in June. You're seeing an 84% chance of it priced into the markets. It comes after the central bank held rates yesterday, but in a contested decision.
The dynamics of underlying inflation and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction.
Joining us now is Bloomberg's Yana Randolph. She's, of course, covering the ECB very closely. Yana, a pleasure to have you on the program this morning. When we talk about the ECB, perhaps front-running the Federal Reserve, What does that kind of mean in terms of strategy after that first rate cut? If we get that happen in June, is that just setting up the stage for rate cuts every meeting onwards? How is the ECB thinking about it?
It's an excellent question, and I'm afraid I'm not having an answer for you just yet. The president really left all her options open. We heard it in the clip. She said, if confidence in the inflation path toward 2% increases, then the ECB can remove some of that restriction. But she also said policymakers are not pre-committed. They will continue to look at the data and see how it comes in. And of course, we get the next projections in June that will tell us a lot, and that everybody expects to form the basis for that first cut. What happens after is very unclear. I mean, the projections so far, the March ones, they are built on assumptions that the ECB would be cutting interest rates by about 100 basis points this year. If strictly speaking, if you want those projections to materialize, then that's the kind of easing you have to deliver. But of course, things change and things happen. So the ECB said, and Lagarde stressed that very, very clearly. They will look at the data, they will see how it pans out, and then they will take their decisions. And of course, what happens in the US, what happens at the Fed will play a role. She was, she found quite nuanced language there yesterday on how the ECB is affected by those decisions and by economic trends across the Atlantic.
Jana, 24 hours ago, you were on our show with us talking about this idea that maybe the markets could be getting ahead of themselves. Maybe a cut didn't need to happen at yesterday's meeting. Now we're starting to see that actually the members of the ECB itself, some of them actually said there might be a need for it. Can you walk us through some of the divergences within the ECB itself?
Yeah, I mean, we knew going into the meeting that there were a few governing council members who hadn't excluded moving in April, knowing that they probably wouldn't have a majority. So arriving at the ECB, there was a group of people that thought, let's talk about it. And if I had to say, I would favor going early. And they are, of course, referring to an extremely weak Eurozone economy where, manufacturing is still shrinking, where confidence is really just inching up, where demand for corporate loan demand is really disappointing, which of course means prospects for investments are very low. Where inflation, for example, is falling faster than expected for months now. So they saw room to already start moving. But the large majority of governing council members said, no, let's wait for the data. We said we would be data dependent, so let's look at it. So there were a few that took a while longer to convince, but ultimately the president said as well, everybody rallied around that consensus, setting up June.
Yeah.
So it would take a lot for that move not to happen.
Bloomberg's Jana Rando walking us through the dynamics over at the ECB, potentially marking the start of a historic next couple of months on the continent. I'm very excited about monetary policy all of a sudden on this continent. We thank you so much for joining the program. And of course, as we're having that conversation, we have headlines crossing here from the ECB Governing Council member Kazak speaking on TV3 channel, kind of reiterating what Jana was just talking about, saying they will cut in June if nothing surprising happens. Still talking about very strong wage growth and that a moment for a rate cut is near, that the data will indeed be clearer in June. You are seeing some weakness in the euro, not necessarily off the back of that, because that trend was kind of already in place, but certainly one that we're going to be keeping an eye on as we see more of perhaps a read-through into the bond market. We go from the macro and the monetary policy to a little bit of the micro. One of the major stories we're watching from around the world, Apple shares closed sharply higher after a Bloomberg report that the tech giant is preparing to overhaul its entire Mac lineup with AI-focused in-house chips. For more on that scoop, let's bring in Bloomberg's Peter Elstrom. Peter, this is a very big deal for a variety of reasons. One simply being that when we talk about the AI momentum story and the trade there, Microsoft, Alphabet, Amazon have all kind of dipped their toe into the AI story. Microsoft perhaps leading the pack there. Apple has been noticeably left behind. Does this change the game?
Well, I think so. The news here is really that we're getting a new lineup of Mac computers, and they're not just Mac computers, they're AI Macs from Apple. And everybody seems pretty excited about that. It seems like Apple is taking this very seriously at this point. As you mentioned, they have been a step behind on some of these new technologies, with OpenAI charging ahead with ChatGPT and Microsoft also making a lot of progress. So what we're seeing now is that Apple is planning to introduce a new M4 chip, a processor that will be able to handle a lot of those AI capabilities more smoothly than the chips that they've done in the past. Apple, for a few years, more than a decade, has been designing its own silicon to be able to take full advantage of the software that they've got and other capabilities. Now artificial intelligence is going to be a priority. This is a very fast refresh of the Mac lineup. They introduced the last lineup of Macs just in October. This was with the M3 chip. And so by the end of this year, we're going to start to see these new computers come out, the MacBooks come out with M4 chip that will be able to handle some of these AI capabilities. As you mentioned, investors have been quite excited about this. Apple shares are up 4.3%. Those shares have been a little bit sluggish of late. And also you saw a bunch of their suppliers here in Asia also make some gains. That's partly because sales of these computers have been slow. There's been a drop-off. In the last fiscal year, we saw Apple computer sales drop 27%, which is pretty sharp. That's led to some of these problems with the stock over the recent months in particular. And now it seems like there's some hope that they'll be able to refresh the lineup of what the products they have and then spark more demand.
Well, speaking of that sparking demand, Peter, it's perfect that you're based out in Asia, because one of the really weak spots of that demand story has been in China. It's also arguably been in the emerging market space. Samsung has really taken a big chunk of market share from there. Could this help appeal to that customer?
Yeah, I mean, their Apple sells, of course, a big lineup of products. By far, the most important product for them is the iPhone. And the softness I think you're referring to is their struggles in making sure that their iPhone sales continue to gain a lot of momentum. They're, of course, right at the top of the market, the premium price product out there. In China, in particular, they've had some struggles over the past year. Partly, as Bloomberg has reported, there's a government ban on using iPhones in a number of different markets. Also because Huawei has come back into the market. In addition to Samsung, which has long been a very formidable competitor, Huawei is coming back into the smartphone market in China. That's the second biggest market for Apple after the United States, and that's created quite a few problems. So this new lineup of Macs with the M4 AI chips is likely to help on the computer side of the equation, but they still have some challenges on the smartphone side of the house.
All right, Bloomberg's Peter Elstrom walking us through that Bloomberg scoop. We thank you so much. Does this change the game from Apple? And of course, we're going to keep an eye on how they trade in today's session, whether or not they actually lead the pack again when it comes to the U.S. stock story. That's just one of the things we're going to be watching in the day ahead. There's plenty of macroeconomic data that we're going to be keeping an eye on. At 7 a.m. UK time, we do get those GDP numbers. We'll be breaking those live on markets today, talking to us about the health of the UK economy. Is there early signs of stagnation? That data coming out at about 7 a.m. UK time. And then 12 p.m. UK time, we get that highly anticipated report from Ben Bernanke, the former Fed chair, who has been asked to talk about how the BOE can really work on their forecasting story. Do we get some sort of scenarios push as opposed to the current fan charts? What does those recommendations or options actually look like? We'll be diving into that throughout this show in just a couple of minutes, I think, as well, with a really great guest. The actual report coming out at about 12 p.m. UK time. And then the focus goes into corporate America, but specifically those Wall Street banks, Citigroup, Wells Fargo, JP Morgan, kicking off the earnings story there. When we're talking about the rate cycle potentially ending, does that mean peak margins for a lot of these banks? We're going to dive into all of it. But coming up on this program, we talk geopolitics. President Joe Biden vows to back Japan and the Philippines amid growing Chinese influence in the South China Sea. We'll have more on the joint summit next and why you should care if you're an investor. Plus, as I just mentioned, former Fed Chief Ben Bernanke is set to unveil his review of the BOE's forecasting models today. Michael Saunders weighs in, the former member of the BOE's Monetary Policy Committee, coming up at 6:40 a.m. London time. It's an interview you do not want to miss. Stick with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. I'm Kriti Gupta in London. The U.S., Japan, and the Philippines say they are committed to a free and open Indo-Pacific. The statement comes after a summit between the three countries' leaders following increasingly assertive Chinese actions in disputed waters. Let's bring in Bloomberg's Isabel Reynolds in Tokyo. Isabel, a pleasure to have you on the program. This is a story we've been watching, of course, as the two leaders, first Japan and the United States, meet, now bringing in the Philippines as well. Can you walk us through the kind of the needs that Philippines has right now when it comes to the South China Sea? How does the summit change the game for that country?
Right. Well, I think that the overall message from the summit was very much that President Biden came out with this ironclad so-called commitment to the two allies in Asia, two of the most important allies that the U.S. has in Asia. And the reason I think that he's doing that now is partly because we've seen this huge rise in escalation in tensions in the South China Sea recently. We've seen the Chinese Coast Guard fire water cannons on Philippine ships. So it's clearly becoming a situation where people can actually be injured or possibly even killed. And that's something that I think all three countries want to definitely calm down. Not only does Japan also have its own separate territorial dispute with China, but is also concerned about the South China Sea as a waterway, as a massive trading nation. It wants to be part of this effort to keep the peace there, keep law and order there, so that its economy can keep ticking over as normal.
And it comes, of course, at a time when the U.S. in particular has a naval presence in the Philippines as well, but of course has a real lack of funding when it comes to Pacific Command. If you see South China Sea, the situation there increase or ratchet up even further, the U.S. is kind of out of luck in a lot of ways. How has China reacted to this when we see this rhetoric coming out of the summit?
Right. We haven't actually seen a reaction yet to the three-way summit, but the reaction certainly to the two-way summit, to the bilateral summit yesterday. There was a statement that came out afterwards condemning China's actions in the South China Sea as dangerous and escalatory. And the reaction from the Ministry of Foreign Affairs in China was not happy at all. They made formal complaints both to the U.S. and to Japan about that and said that this relationship should not be something that is targeting another nation and should not be harming another nation. So they're clearly not happy about that. But on the other hand, we also have reports that next month we'll see a trilateral summit between Japan, South Korea and China in Seoul. So there's a possibility that things can be slightly patched up. Despite all these military tensions in the region, China does remain a very important trading partner for everybody in the region. So I think everyone wants to see the tensions calm down as far as possible.
It's a really fascinating story, and it comes as not only the military tensions, but of course the security in terms of cybersecurity and chip security all come up ahead of a crucial election cycle in the United States. Bloomberg's Isabel Reynolds, our Tokyo bureau chief, we thank you so much for that crucial context this morning. We go to the latest now in the Ukraine war, where Russia has destroyed the Kyiv region's largest power plant and attacked gas storage facilities. The assault adds to concerns that Ukraine's military defenses are near a breaking point. Western officials say that Kyiv is at its most fragile moment in over 2 years of war due to a dire shortage of ammunition and manpower. It comes as the United States lawmakers continue to argue over a $60 billion aid package. Meanwhile, the European Union moving towards unlocking additional aid of almost 2 billion euros to the war-torn nation. Now, off, of course, that news coming out of the power plant, we saw a massive move in European gas, up to 8% in yesterday's session. We haven't seen the European gas story open today's session just yet, but it'll be interesting to see if that continues as we, of course, wait to see what the supply chain impacts are and whether or not they spread broadly into the market or if this was simply a one-off. And, of course, sticking with the commodity picture, I want to get a quick check on oil as well, because we are keeping a very close eye on the Middle Eastern tensions as well. What does an Iranian response to some Israeli hostilities in Damascus actually look like? We've seen Biden and his allies around the world really push back against an Iranian response altogether. Nevertheless, that could mean supply dynamics are in play. Brent crude trading at a 90 handle, not really pricing in that risk, but that, of course, may change as we get headlines. An 85 handle on NYMEX crude, both higher in the green, probably in line with some of the risk sentiment we're seeing in futures at the moment. Coming up on the program, electric vehicle sales are expecting to slow down this year, but slow growth doesn't mean no growth. We'll be looking at what's knocked consumer confidence in the EV market next. Stick with us. This is Bloomberg.
in terms of the EVs. The growth is there in the market. Perhaps the consumer moving into the EVs is at a slower pace than what some had dreamed about.
It's important to understand that the automotive space is not like Silicon Valley in the sense that this is not a space where there's a winner-take-all technology. Right?
Consumer gradually will be better educated, but at the moment, infrastructure and battery costs and the price and affordability, many very high hurdle for customer to purchase. So it is going to be a slow adoption pace.
Auto executives from around the world speaking to us recently about the challenges in the global EV market. I want to stick with that theme for our weekly deep dive into the green energy transition. Bloomberg NEF expects 16.7 million electric vehicles to be sold worldwide just this year. The forecast is 22% higher than 2023's, but still marks a slowdown from a 30% jump that we saw last year. Now, the numbers point to a bumpy road for the EV industry over 2024. I want to get a little bit more on this and bring in Alexandra O'Donovan, head of Bloomberg NEF's electrical vehicles team. Alexandra, talk to us a little bit about this slowdown here. Is this a one-off, or is this something that's actually going to play out with perhaps more momentum or a bigger deceleration this year?
Well, there has been a lot of those overly dramatic headlines in the news in the past few months, pointing to the slowdown, to the decline in EV sales. But looking at January, February data so far, those don't seem to support that thesis yet. So everyone is looking at the big EV markets, so China, Europe, the US, and in those markets, EV sales were, for those first 2 months in the year, still up. So in China, that's 38% up, Europe, 14%, US, 16% up. There's also quite an interesting and exciting story developing around emerging EV markets like India or Thailand, where sales are growing really fast. So right now, EV sales are not falling off the cliff yet. They're still up.
Well, talk to us then about the sustainability story, actually, in terms of when it comes to things like input, for example. Is the cleaner EV story accurate? And the reason I ask that is because you hear so much narratives about the actual technology about EVs, that it's cleaner now, but in the longer term, lithium, battery usage, et cetera, may not actually be as sustainable as it seems at the moment. What are your thoughts there?
Well, actually, it's quite the reverse. So EVs are already much cleaner than petrol and diesel cars. A lot of that debate around the life cycle sustainability of electric cars stems from the fact that in the manufacturing phase, EVs are quite emission intensive, and that's down to the emission intensity of battery manufacturing process. However, once on the road, those electric cars actually are much cleaner, and gasoline and diesel cars become much more polluting very quickly, and that's down to the use phase emissions that gasoline cars are associated with. So today, if you buy an electric car today, drive it for 250,000 kilometers on average, life cycle CO2 emissions of those cars are already up to 71% lower than comparable combustion car. And, the good news is it's still is set to get even better than that. So as grids get greener and renewable electricity generation increases over time, electric vehicles are becoming even cleaner.
Well, certainly something we're going to be watching very, very closely. Alexandra O'Donovan, head of Bloomberg NEF's electric vehicles team, bringing us that crucial story this morning. If you want to hear from more of BNF's analysts, download the Switched On podcast on Apple, Spotify, or wherever you get your podcast. There is plenty more ahead. We're going to go back to monetary policy. It's a conversation you do not want to miss. Stick with us. This is Bloomberg. Good morning and welcome to Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. The Magnificent Seven driving a rebound in the U.S. stock market, with Apple unveiling plans for a new in-house AI-powered chip. Meanwhile, on the monetary policy front, traders repriced the ECB, putting it on track to cut before the Federal Reserve. Christine Lagarde insisting that Europe's central bank does not take cues from across the Atlantic. Plus, in the corporate space, Wall Street bank earnings are in focus. JP Morgan, Citi, Wells Fargo, all set to report today. There's plenty to digest the next 24 hours. Do not check out for the weekend just yet. In the meantime, I want to get a quick check on these markets. You are seeing green on the screen when you look at the futures picture. Eurostoxx 50 futures higher by 0.7%. The FTSE 100 right on its tail, higher by about 0.4%. We're seeing a little bit of complacency, a little bit of caution is going to be in the U.S. market. S&P futures 52.44 on those contracts. Unchanged this morning, despite the fact that you did see a rally in yesterday's trade. You are not seeing international investors hop in or even follow through when it comes to the futures contracts. The cross-asset story to me, though, is a little bit more interesting because we were talking about complacency in the U.S. market. What about complacency in the FX market, especially when we're seeing a 10-year yield at 4.56, a slight bid there, 2 basis points lower on the yield. Really not much action in the currency space. 107 on euro dollar, 125 on cable, and Brent crude trading at a 90 handle. Now, all of this may actually change within just a few minutes. We're going to have the latest UK GDP figures coming out at the top of the hour. We're also looking ahead to today's release of former Fed Chair Ben Bernanke's review of the Bank of England's forecasting models. Plenty to discuss about how this actually approaches or even changes the game for the BOE and investors that watch it. Anna Andrade joins us this morning from Bloomberg Economics. Anna, a pleasure to have you on the program as always. Let's start with the data first. These GDP figures, does it suggest any sort of early signs of stagnation if we've kind of thrown recession perhaps off the table? What are we expecting?
Hi, good morning. So for today's data, we're actually expecting a flat reading of GDP. Consensus is looking for a modest growth of 0.1%. Readings around these figures might not sound that positive, but they're actually enough. After January's data, they're actually enough to confirm that the UK economy has sort of turned a corner, and has returned to growth in the first quarter of the year after the recession that we had. I think now the question for the UK economy is whether the sort of recovery, is it just a rebound, a one-off, or is it sort of a lasting recovery, number one? And number two, whether the recovery will endanger the sort of inflation progress that we've seen so far. And on the first one, we actually think that we're looking at the growth rate of 0.2% for the first quarter. And we think that's what it will stay for the rest of the year. There will be a lot of drivers sort of sustaining that growth rate. And then on the second question, it's a really good change. It's a change from 2 years of stagnation into 1 year of 0.2 growth. It's good. It changed the picture for the UK economy, but growth won't be as strong as to add to inflationary pressures because it will still be sort of running below the UK's supply growth, or what we estimate is the UK supply growth.
It's a really interesting dynamic then, because it feels like the early signs of the fact that the UK is not even on the same path as, forget the United States, but even the ECB. It's kind of doing its own thing. You now have 3 major central banks truly diverging in a true way. Talk to us a little bit about this review coming from the former Fed Chair Ben Bernanke. Perhaps the dismissal of fan charts that catch such the ire of investors, but also talking about this idea of scenarios. What are you looking for in the strategies that he may recommend?
So I think scenarios have been floated around because it's one area that I think the MPC is open to change. So the way that the MPC and the BOE communicates uncertainty around the outlook is by the use of fan charts. But there's some arguments that can be said about that scenarios are probably they improve the narrative, and they're easier to understand in the sense that instead of just presenting sort of a possible range of outcomes for inflation, you actually tell the public how you could end up in those sort of extreme scenarios for inflation. So they could improve a bit the narrative. But what we're looking for today, and I think what's sort of the long-standing challenge of the BOE, it's its communication around the rate path and the fact that we're kind of left a bit in the dark about where it thinks rates will head in the future. And so Bernanke, the big question is whether Bernanke will propose that the BOE shifts to producing its own interest rate forecast. So not something like the dot plot, but maybe a path for interest rates that it's backed by a model and added on judgment, and that will improve communications, our jobs, I think, massively. So I think this is sort of the area we're looking for and more focused on. Maybe
making Anna Andrade's day a little bit easier. Perhaps I will say the dot plots itself come with so much criticism as it is. Anna Andrade from Bloomberg Economics, we thank you so much for setting us up for that review, again, coming up at about 12 p.m. UK time. I want to get a little bit more analysis here and bring in by someone who's actually been in the room when these decisions are made. Michael Saunders joins me this morning, former member of the Bank of England's Monetary Policy Committee. Michael, a pleasure to have you on the program. Thank you for waking up early for us. I'd like to pick up where Anna just left off. This idea of scenarios, this idea of perhaps communicating better from the BOE. What is your view on it? Could this idea or this potential recommendations of scenarios, this if this happens, then we expect this, do you think it would make that big of a difference?
I think it will be useful. The question here is, how do you deal with uncertainty around the central forecast? At the moment, what the Bank of England does is to publish a fan chart. They have a central forecast, which is sort of a thick line in the middle of the chart, and then gradations of color gradually diminishing in density around that and getting wider as the horizon goes forward to illustrate uncertainty around that central path. The problem is those fan charts are so wide by the end of the forecast that they don't really serve much purpose. They sort of say, well, 2 to 3 years out, almost anything could happen. I think scenarios have the advantage of illustrating what might happen to the economy, inflation, and interest rates if particular risks which the Bank of England is focusing on were to come into play. Right now, you could think, for example, a scenario might be on the upside, stickier pay growth, perhaps more persistent inflation, a higher for longer interest rate outlook. And on the downside, perhaps a weaker growth outlook, which might lead to lower inflation and a faster decline in interest rates. It's a useful way of converting this rather vague sense of uncertainty, which the fan charts give, into something much more coherent about how the major risks might play out.
You use that key phrase, how the major risks may pan out. It's interesting because it's coming. This review was initiated to begin with off this kind of miscommunication around really black swan events that nobody saw coming. A pandemic, supply chain shocks, not to mention the story you had in the gilt market as well. I'm curious about what happens when you forecast certain scenarios, but you can't accommodate all of them. Does that suggest or even set up the BOE for some sort of lack of credibility or extra criticism around being unprepared for the events that they can't see coming?
Well, no, I think that you would always have scenarios which are based on the risks which you see at the time. And then as the situation changes, you might change the scenarios accordingly. You can imagine, for example, in early 2022, when Russia's invasion of Ukraine was just getting underway, you might at that point have introduced a scenario which had a much bigger, a more extended rise in energy prices and worked through how that would affect the economy, inflation and interest rates. I think that would have been a useful exercise to show that and to make it clearer that when you get a shock like that, the scale of the shock can have quite significant effects on policy over a period. And as I said, at the moment, there's not really any way of doing that in the fan chart mechanism. I should come back to one other thing, though, that doing a review is not just a response to criticism. Expert-led external reviews of central banks, I have to say, to me, that should be a regular thing which you do. The Central Bank of New Zealand does this, an expert-led external review, roughly every 5 years. And the expert-led reviews produce very important reports. The central bank then takes on, adjusts its behavior where necessary. That's a sort of continuous learning process where you're trying to learn the lessons from your own experience and the experience of other central banks. I do very much hope that people don't view this as something which you only do because something's gone wrong. It should just be a regular way in which the Bank of England, and I would suggest other central banks, seek to ensure that what they're doing is always best practice.
It makes a lot of sense, and perhaps setting a precedent for others to follow as well. Michael, I'm curious about where this goes wrong, though. What are the limitations around these scenarios? Could fiscal policy, for example, be one at a time when a Labour victory is expected in the polls but may not be included in the BOE's kind of former forecasts? Where do scenarios stop short?
Well, look, you have to recognize the limitations of any forecast, that it's going to be based on certain assumptions, and those assumptions may not hold if the situation changes in some major way. That's just the unavoidable limitations of any forecast. So you and all sort of all external users should never take forecasts as being a promise or as implying that the only possible outcomes are those which are shown in the central forecast or scenarios. Forecasts are a useful tool. They're a useful tool for policymakers to think about what the policy choice should be, and a useful tool to communicate the central bank's monetary policy strategy to households, businesses, and financial markets. But of course, there are always limitations.
Michael, talk to us then about how the markets get involved here. I mean, there have been so many criticisms, ironically, coming at Ben Bernanke for even inventing the dot plot because of the way the markets use it, not as the way economists intended it to be used. The repricing you're seeing around the BOE just this week alone has been largely Fed-driven as opposed to driven by UK economics or UK fundamentals at a time when the BOE uses that market pricing or the market expectations as a part of their policy. Where should markets play a role here?
So I have to say, look, the advantage of having the market path for interest rates, as you could say, there's a sort of consistency between the interest rate assumption and other asset prices. The difficulty is that it leaves the MPC producing a forecast based on a market path for interest rates that they themselves may not feel is very plausible. So then the economic forecast is one that, well, often some and at times even most MPC members don't think is a reasonable central case for the economic outlook. And so I'm not sure what what message those kind of forecasts are meant to convey. I do think they need to shift and will shift to a system under which the MPC themselves are making a judgment on what they think is a reasonable path for interest rates over the next 3 years and using that as an ingredient in the macro forecast. So then you would have a forecast for the economy, inflation, and interest rates that the MPC themselves think is a reasonable judgment. That, I think, would be better than the current system with a forecast based on a market path, which the MPC may not view as terribly likely. Now, of course, a forecast based on the MPC's own preferred path for interest rates you still have the issue that that forecast path for interest rates would change over time. Of course it would. A forecast path for interest rates is never a promise. It's just a best collective judgment at that particular point. And as the situation changes, that forecast path for interest rates itself might change. And you can see markets adapting to economic news in the US, currently producing a market path which is different to the Fed dots. The Fed dots were done a few weeks ago. It's only reasonable that the market path should differ from the central bank's assumption in light of economic data that comes through. I think you would want that to be the case.
It's interesting that you mentioned the U.S. You went right where I wanted to go, which is the story of stickiness in the United States. We are no longer seeing the three major kind of central banks that we watch, the Fed, the BOE, the ECB, all on the same path or even watching the same risks. This stickiness in inflation, this persistence in American inflation, given that the U.S. is the U.K.'s biggest trading partner, what's the read-through into the U.K.? Is there one?
Well, of course, the EU as a whole is a much more important trading partner for the UK than the US is. But you're right to highlight that there are divergences between the central banks. They all had the same broad picture of a big rise in inflation and a marked slowdown, but there are differences right now in that inflation is falling quickly to target in the euro area, also falling quickly to target in the US, and a little bit sticky. Sorry, also falling quickly to target in the UK, and a little bit stickier in the US. The UK is going to be back to 2% inflation. Well, in the April figures, the figures for this month, which will get published in the middle of May. And inflation probably is below the 2% target in the rest of this quarter, and probably also in the second half of this year. So sticky inflation in the US, I think, won't stop the Bank of England starting to cut interest rates in the next few months. Probably not May. I would say June is more likely. Interest rates won't be coming down quickly, but I suspect they will be coming down.
All right, Michael Saunders, we have to leave it there, but we thank you so much for joining the program this morning. That's Michael Saunders there, the former member of the BOE's Monetary Policy Committee. We thank you again for your insights this morning. Ahead, by the way, of that Bernanke review of the BOE coming up at 12 p.m. UK time. Coming up on this program in the meantime, the biggest U.S. bank stocks have soared over the past 6 months. But can they maintain that momentum? That's one of the big questions this earnings season. We're going to preview them next. Stick with us. This is Bloomberg.
Berkshire Hathaway is an apt analogy in the sense that we look at a lot of business models, why certain firms have been super successful over time. And there are a lot of powerful messages in what Berkshire has built. It's the power of long-term ownership of assets, great businesses, the power of compounding, and the real power of smart capital allocation within your business.
The co-CEO of KKR there on why he's taking a cue from Berkshire Hathaway's business model, betting big on long-term private equity ownership. When I think Berkshire Hathaway, I immediately think the banks and the way that Warren Buffett has really approached them, which brings us, of course, the perfect setup for investors gearing up for first quarter earnings from the major U.S. banks, JP Morgan, Bank of America, Citi, all reporting later today, and I should say in the next couple of days as well. For more on this, I'm joined now by Bloomberg's Jenny Serrain. Jenny, let's start with the big one. JP Morgan kicking off earnings season. They've kind of been the king of Wall Street, obviously. Does that continue?
I mean, I think we probably won't see any diminishing of that fact today, at the very least. So I think what we're really looking for these guys today is net interest income. So at the start of the year, they laid out kind of what they think is going to happen. If you take yourself back to January, you remember that a lot of these banks were kind of expecting rates to come down pretty quickly. And so they were saying, as a result, our net interest income was going to come down 3 months on. That's definitely much more of a debate than it was back in January. It seems like we're definitely in this higher for longer stage. And so I think you'll see that in the way they talk about both the net interest income they had in the first quarter, but also their outlook for the rest of the year.
It's interesting that we talk about net interest income because if we're pricing in these cuts, is this peak profits, at least for this cycle? And I'm curious if it shows up more in a JP Morgan or more in a Wells Fargo.
I think so. Those two are probably pretty equally exposed to the interest rate risk side of things. So I imagine we'll be hearing a lot of the same things out of Jamie Dimon that we hear out of Wells Fargo CEO Charlie Scharf. And I really do think that, if rates stay higher for longer, then yes, we'll be continuing to be in this kind of peak profit mode. But I think that they're going to be trying to really sell investors on and get investors ready for is when those rates do start to come down, if they come down super quickly, or even if they just kind of migrate down more slowly, that's when you'll start to really see some pressure on the revenue side of things. So definitely, I think the tone of today is not going to be a super upbeat one, even if the results still look really strong given where rates are at right now.
And we're going to watch, of course, Citigroup as well. But I really want to get to Morgan Stanley because there was a probe announced in their wealth business in just the last 24 hours. Can you walk us through why this is so important?
Yeah, no, I think that's it's interesting. So the Wall Street Journal reported that they're under investigation by a myriad of U.S. regulators for any money laundering issues. And this is something that you kind of see lurking all the time with these big banks, is they're always kind of under investigation for different things. AML is such a key one because this is when you get into things like terrorism financing and things like that. So that's why these regulators take it so seriously. The penalties can be really big. The remediation is usually long and arduous, expensive. So that's why I think you're seeing the stock reaction in the Morgan Stanley stock the way it did. It's just such a thorny issue. It's not likely to be one that can be wrapped up super fast or something that, this new CEO, Ted Pick, probably wants in his first few months on the job.
It's also interesting because their wealth business is one that they're trying to really grow and really take kind of a lot of momentum with. Bloomberg Jenny Serrain, we have to leave it there, but she will be back in the next couple of hours. We can't let her go. We thank you so much for that crucial context. Folks, there's plenty more ahead. We go back to the macro in just a few minutes. Stick with us. This is Bloomberg.
Well, it's a bit kind of arrogant to say that the market is wrong, because what is the market? The market is the total IQ of all the people in the world, right? So that's a tough one. I do think that inflation will be tough to get down. There is more nearshoring. We are seeing some. We have recently seen some more pressure on raw materials. Wage increases are quite high. So I suspect that we won't see the type of rate cuts that many people expect.
And that reprices everything, including your investments.
Well, that's what you would have thought, right? But markets have been relatively resilient on the back of changed interest rate expectations. That's been a bit surprising to me.
But is that because they still believe it's a cut, where actually we could see a hike?
Partly that.
What do you see? I mean, there's this U.S. exceptionalism, which is what we're seeing in the U.S. economy, the inflation data, what the Fed does. What have we gotten wrong on the U.S. economy?
Well, the U.S. economy is actually pretty good, certainly relative to Europe, right? And we see it as well when I see U.S. CEOs, they are just seeing the backdrop for doing business in America is so much better than doing business in Europe. So a lot of things are going right in America.
The Nikolai Tangin, CEO of Norges Bank Investment Management, speaking to Bloomberg's very own Francine Lacqua. Look what he says there. The U.S. economy is pretty good. Things are looking resilient. And he sees that across the board. So what does that mean in terms of the markets? And for me, it's all about the yield. It's the bond market story, which brings me to this chart. We continue to see the story of, is 5% on the horizon? Well, I decided to do a little bit of history. When was the last time we were at 5% on the U.S. 10-year yield? Well, that brings me right back to really the fall, where you started to see this 5% level. If I were, go with me here, picture the U.S. stock market overlay here. Every single time we get closer and closer to that 5% level, we see a drop in the stock market. That is the scary part, the repricing you were seeing in the equity story, given that the bond market momentum is actually increasing. That's what this is all about. So where do we go from here? Because you're now not seeing that same level of momentum, that same steepness in yields here. And that's where this part of the chart really matters. You're kind of seeing this gradual move up to that 5% level. But what are the key technicals? And that's where these yellow lines really make sense. 5%, 4.7, these technical levels that bring us back to the past in terms of moving where the bond market is actually going to go. And that's going to be a crucial equation in terms of what is actually getting priced in, not just for the Federal Reserve, but for the BOE as well. And the central bank pricing largely driven by the Federal Reserve, as opposed to the fundamentals that you are seeing across the board. And that's where this chart is really handy. Look, it's all one line, despite the fundamentals being very different by the three major central banks that we watch around the world. That's going to be a major topic of conversation coming up on markets today. This morning, we have plenty of big guests that are going to weigh in on what the markets are getting right and what they're getting wrong. We have an exclusive interview with Jean-Claude Trichet, the former president of the ECB, that coming up at about 7:15 UK time. Up next, Markets Today, Anna Edwards, Guy Johnson, join me to take you through the European market open. Stick with us. This is Bloomberg.